Welcome to your first lecture on IAS 12. Now, this standard is on accounting for income taxes in its entirety, not just deferred tax, although we will spend 90% of our time discussing deferred tax. Now, for a lot of you, you've heard of deferred tax, and either you don't know what it is or it scares the pants off of you. Today, we're going to start the process of fixing that. Okay, so a couple of concepts just to remember here, ladies and gents, is that we do have accounting profit, which we account for in terms of our accounting standards, right? And we use, in this course, we're using IFRS, International Financial Reporting Standards. But then each country also has its own tax legislation. And you will end up having to work out a taxable income in order to work out how much tax will be levied for your company. Now, we'll just refer to this as taxable income, sometimes tax profit. But remember, this is not IFRS, this is your tax legislation and country-specific rules. Okay, so IAS 12 says we must use the statement of financial position approach. Realistically, what is the balance sheet or financial position statement? That is the cumulative totals, right? Whereas the income statement or statement of profit and loss is just the movement between last year and this year. Okay, so the movement between two balances. We're going to focus on the closing balances first and then work out the movement between. But before we do that, I need you just to refresh. What is an asset? An asset is future economic benefits in terms of the framework, right? So future economic benefits, you have a timeline, and you have an asset, PPE, a machine, for instance, right? And it's going to be earning you income in the form of operating profit today at your reporting date. Okay? Liabilities, similar concept, but here we're talking future outflows. Yes, it has to be a present obligation, etc., etc. In terms of the framework, though, conceptually, it's a future outflow recorded at today's value. Okay. But now we have an item of PPE, which has future economic benefits, all before tax. Okay, so these future benefits are all recorded before tax. What do you need to do about the tax effect? Okay, so we're going to discuss that, and in essence, okay, the issue comes up where your accounting profit does not always equal your tax profit. Okay. So there are going to be temporary differences between when you should have a tax expense in your books, if you're looking purely at accounting, versus when you actually put the tax expense into your books because of tax legislation. Okay, so let's just have a quick look at assets now. Again, we're trying to cover the basic understandings here. So as I very roughly drew on the previous slide, an asset today, whether it's PPE, inventory, debtors, consists of future economic benefits, which are basically discounted back to today's value and recorded at such an amount. The question was that I asked you, what about the future tax effects? So these future benefits, which in this case will be income, okay, will result in future tax outflows. And all we say here in IAS 12 is that we must record the tax liability in order to record the tax expense in the correct period. Okay, and then for the liabilities, a similar thought process. Future outflows to recognize a liability, an accrual or some type of financial liability today. Okay, and those will have future tax deductions probably. Okay, so we must recognize the future benefits from the tax deduction as well as the future outflows for the current recognition of the liability. Okay, so underlying concepts here. We must technically match the tax expense to the accounting profit before tax in terms of which period. Okay, that's the accrual concept. I'm not talking about changing the actual tax return, okay, but what we're going to have to do is realize that there will be two components in our accounting records. Okay, namely, we will have both current tax as well as deferred tax. Now, the current tax is what you put into your tax return. Okay? The deferred tax is technically where you are applying the accrual concept or matching your tax expense to the accounting profit before tax. Just remember there's also two elements we're going to talk about here, or two statements, right? We will talk about tax expense, which is I'm always going to refer to as the movements, okay? And that's going to both either be in profit and loss or other comprehensive income. Whereas then we'll also have our tax assets and liabilities being the balances. And that will be in the statement of financial position. Remember, there will be current as well as deferred tax balances. Okay, so please just remember, okay, the principle here is that our accounting profit before tax does not necessarily equal our tax profit or taxable income. Okay, but what we do need to do is we need to recognize the tax expense in the correct period for accounting records. Okay, so there we are talking about the accrual concept as being highly important. Now, the easiest way to do this is look at numbers. So the next video, I'm going to do a very basic video, okay, going through a basic example for an illustration of these basic temporary differences. Please watch that to get a grip of what we just discussed of. Thank you.